Well, good morning or good afternoon to all of you joining us on the West Coast, the East Coast, or watching this replay from around the world, hopefully. Thank you so much to CFA Society San Francisco for hosting this panel and this event, and thank you to those of you who are joining. I'm very excited to be speaking with our two speakers today, Lauren Goodwin, Chief Market Strategist at New York Life Investments, and Ed Yardeni, President of Yardeni Research. We have so much to discuss that I will not read their full bios. You can either read those on your own, or you should recognize the two of them if you're a CFA charter holder or a member or a candidate going through the program, because both of them are in the CFA program curriculum in various ways and places. So we timed this event intentionally. Yesterday wrapped the two-day meeting of the FOMC, which this time was accompanied by economic projections as well as the statement and customary press conference. And these two experts joining us today are on top of all of that data and the tea leaves, and are guiding their organizations and their clients through that all the time. And so we're very lucky to have them today, the day after that event yesterday. And that's where I want to start, Lauren and Ed. You know, personally, I did hope yesterday would be more exciting than I think it was, but I'm sure both of you read all of the Fed's materials and watched the press conference and did your analyses for your organizations and clients. Lauren, let's start with you. What was your what were your main takeaways from yesterday?
Sure. Well, thank you so much, Devin, and the CFA Society of San Francisco for having us. Ed, it's great to see you. Great to be discussing today. A couple of takeaways that I took from not just the Fed yesterday, but also the inflation data and jobless claims data we've gotten here over the past couple of days. First of all, last couple of months, I think the market has been getting more comfortable with the idea that we are starting to see late cycle data. That's not necessarily any sign of impending doom or rapidly approaching recession. But typically, as the Fed starts raising interest rates, the economy tends to evolve in a very similar fashion. And it's only when you get to profit margins starting to decrease that you would see weakness in the labor market. And so the fact that the labor market is strong isn't surprising to me at this stage in the cycle. But the fact that we are now just starting to see what I perceive as more comfortable disinflationary evidence, I think is really important for the Fed. So I was not shocked, not surprised, but interested to see the Fed revise its statement of economic projections to look for one interest rate cut over the course of the second half of this year, as opposed to three before. From my perspective, this is allowing them quite a bit of flexibility. The market was expecting one or two, may as well, especially on the back of slightly more accommodative inflation data, give the market the expectation that we may be higher for longer. And if we see deterioration in the labor market, then they can act more quickly if that's necessary. So I think they left themselves a lot of flexibility. I think the press conference was incredibly boring on purpose. When you get an inflation report that points you in the right direction in terms of your policy is having the intended effect on price stability, best thing you can do is just not say anything at all, which I think Chair Powell achieved. And so my assessment of the economy and markets as a whole is that this plateau of high for quite a while interest rates is where we'll sit for another couple of months, but we are starting to see that early evidence that the Fed's policy not only has been working, but is starting to impact prices in a way that puts them a little closer to target over the next few quarters.
And Ed, before we get to you on yesterday, Lauren, since you mentioned watching the labor market very closely and looking for, looking for any signal of softness there, that's something you and your team have been talking about quite a bit. What kind of signal are you looking for to see a potential slowdown in the labor market?
Sure. Well, I'll give two answers to that question. First of all, just a very specific Fed cuts checklist that we've been looking at. We all know that the Fed looks at price stability and full employment as its two mandates. On the price stability front, we'd like to see, or we expect that they would need to see, rather, both long and short-term inflation expectations remaining intact. That's been pretty much the case over the course of the cycle. Pretty remarkable given the spike that we saw in inflation. But also that they'd need to see inflation decelerating closer to 2% in a way that they felt confident. And this condition hasn't been met yet. The Fed's been very clear that they need to see a couple more months of evidence from here. So this week was a good start, but perhaps not conclusive. Then on the labor market, our anticipated sort of trigger points are an unemployment rate of 4%, which we have now seen in the labor market, but wage growth commensurate with a slowdown in inflation, which we don't believe has been met. So that's what we'd be looking for our expectation of where the Fed would feel confident in cutting rates. But in terms of a slowdown specifically in the labor market, and really what I'm looking for there is like, what's the market trigger? When does this relatively benign, if not actually quite constructive, economic growth and earnings environment start to become worrisome potentially? That's when unemployment claims start durably rising. Little bit higher today. They come out every Thursday. But I'd expect to see 260,000 new unemployment claims as a more worrisome indicator, and we're not there yet.
Ed, you had said regarding the Fed and what may happen next, or what you expect to happen next, that they should just take the rest of the year off, essentially.
Yeah,
Did yesterday change your view on that at all?
no, not at all. Quite the opposite. I think I'm not expecting the Fed will do anything over the rest of the year. They've obviously pulled back the expectations based on the summary of economic projections instead of signaling that they were going to do 2 to 3 rate cuts this year. Now, as Lauren pointed out, we're at one rate cut for the rest of this year. But I think as we look further out into next year, we might as well look at at least a 12-month period, if not the next 18 months. I think the economy is going to continue to be remarkably resilient. I think the consumer is in very good shape. I think what a lot of the naysayers on consumers have been missing is the very important economic impact of the baby boom generation, and many of them are retiring now. And as they retire, they're going to be saving less and they're going to be spending more. And I think we're already seeing that. And not only that, but where they're spending is where we're seeing record levels of employment. So healthcare employment is at a record high, hospitality and entertainment, recreation, leisure, all those are at record highs. And so the economy is looking pretty good from the perspective of the consumer. Capital spending, technology capital spending is very, very strong. Look, the economy many years ago was kind of led by the agricultural sector. We had the agricultural revolution, I guess, in the 1800s. And then in the 1900s, we had the industrial revolution. And now I think we're looking at the digital revolution. And technology, the digital economy is less interest rate sensitive. It generates a tremendous amount of cash flow. And as a result of that, the tremendous increase in the Fed funds rate from 0 to 5.25% really hasn't had the impact that many economists were anticipating because of the resilience of the consumer, because of the move towards high-tech spending. Half of current dollar capital spending now is on technology. And that's actually probably an understatement because it doesn't include all the technologies that are incorporated in capital spending.
Yeah. And Ed, you've moved into a little bit of the discussion of the real economy, the business environment. I want to ask you, Lauren, this is looking back a few weeks, but the earnings season that just wrapped, I think, for S&P 500 companies and for the first quarter season, analysts had, maybe expected earnings growth of like 1.2% year over year. It came in so much higher than that. What's your take on just the earnings kind of environment and outlook after this past season?
Look, I think starting this year, earnings growth expectations were around 13%. I thought that was high. I thought that looked I don't want to say unreasonable, but if you consider that earnings growth was basically flat last year, the idea that with decelerating economic activity, if still healthy, would result in earnings growth of much, much higher. The math wasn't mathing, so to speak. But to Ed's point, we've seen enormous sources of resilience. And I think that while those sources of resilience, each on an individual level, have started to wane. So for example, stimulus payments over the course of the pandemic result in excess savings. Much of that savings has been spent down. And in fact, we're now in net dissavings as an economy. So some of these sources of resilience have moved in a less constructive direction. But when you add them together, especially supports for industrial policy, higher wage growth, et cetera, they appear to be making a big difference. I think we're also seeing a corporate environment, which over the past couple of years has involved high cost of credit, or cost of capital, high input costs. These are all factors that companies have had to deal with, plan for, consider. And so we're seeing some really, as the top line of economic activity moderates a bit, we're seeing companies behave very rationally when it comes to managing their bottom line. Now, again, if we think about sort of what we call the economic dominoes, this idea that as interest rates remain high or even restrictive, they tend to have a sort of toppling effect on sectors in a certain order. When you have those cost pressures impacting companies, what do? Well, they start to try and reduce those costs, including labor costs. So you see hours worked start to move a bit lower. That has not been a rapid trend in the US, but it has been a consistent one. You see small business hiring intentions start to fall off. That's been happening quite rapidly. You see demand for new workers start to wane, which has been happening. It's only after all of that that you would see layoffs. And again, we're not seeing an enormous pressure there, in part because companies have done a pretty good job maintaining those profit margins. So that's a long way of saying that I see corporate earnings trends to date as being very constructive. Again, the earnings environment and the employment environment, they're sort of part and parcel of the end of the cycle. So, the fact that earnings growth and employment are good today doesn't mean necessarily that they have to be good in 6 months, which is why we watch those employment indicators as such an important sort of turning point in the market. But they are the reason why I believe investors have been so focused on growth, or so complacent in a way about growth, and therefore focused on inflation, because these earnings backdrop is constructive, it's healthy, and it's allowed the equity market to churn higher, even with this, incrementally more hawkish, appropriate, and as Ed has said, perspective from the Fed.
Yeah, Ed, on earnings, your team's outlook feeds into your pretty well-known year-end projections and targets for the S&P 500 and
Right.
a decade end target of I think 8,000 on the S&P
Yeah.
500 for this
End
roaring
of the year,
employment.
end of the decade, yes.
Yeah, for the end of this decade. What makes you so constructive on the earnings outlook?
Well, I think first and foremost, the key is inflation. And I think a lot of the inflation we've had over the past couple of years has been related to the shock of the pandemic and the aftershocks of the pandemic. A lot of economists argued that the only way to bring inflation down was to have a recession. Fed Chair Jerome Powell on a regular basis acknowledged that, but said that there might be a narrow path by which we may be able to get inflation down without a recession, and looks like so far so good. And I think what a lot of economists missed is that we have had a recession, but the recession was over in China. China's had a bursting of their property bubble, and now to try to offset that, they are kind of stepping on the accelerator with regards to manufacturing and exporting. And as a result of that, they are exporting deflation. They're basically dumping a lot of manufactured goods in the global economy. And the good news for us is that's brought goods inflation down significantly. So durable goods are deflating again, which was what they typically did prior to the pandemic. Meanwhile, the services economy were kind of waiting for rent inflation to come down, and it has been coming down. It came down again in the CPI, so it's certainly going in the right direction. The CPI, excluding food and energy, is running around 2% right now, excluding shelter. The CPI headline number, excluding shelter, is running again at 2%. So from that point of view, we're already there where the Fed wants to be. It's just a matter of time here where shelter inflation will continue to moderate, as I think it will. So that means that the Fed is not going to be under any. There's not going to be any reason for the Fed to raise interest rates. And people keep talking about R star, this rate at which the economy can grow at a reasonable pace and inflation remains moderate. Well, I would argue we're there. You know, when the kids are in the back seat and said, "When are we going to get there?" Well, we're there. We are seeing the unemployment rate at 4% or less for the past 30 months. I don't think it's going to go up much at all. I'm not expecting a recession anytime soon. I may overstay my welcome in this soft landing, no landing camp, but that's been the case for the past couple of years. And now with inflation moderating, I think the economy is going to do quite well. And I do think that the stock market started to discount the roaring 2020 scenario we've been talking about on November 30th, 2022, which is when OpenAI introduced ChatGPT. So I think tremendous amounts of monies are being spent on this technology. Not all of it's going to pan out, but quite a bit of it will pan out. And meanwhile, between robotics and automation and just simple iPads that are increasingly being used at restaurants to increase productivity, I think we're going to see a productivity boom. I think it started actually, productivity bottomed in 2015. And right now it's running at about 1.8% on a 5-year trailing annual basis, which is pretty good. But I think we're heading towards 3 to 4% productivity, which sounds totally delusional.
Wow.
But that's kind of the pace at which productivity booms occurred in the past. And this productivity boom has more going for it in terms of the technologies that are out there lend themselves to being used by every business, not just a few.
Lauren, before we get to your take on AI and the investability of this technology and revolution underway, Ed addressed, and this is a question that came in from Frederick in the Q&A tab. And by the way, please, to those of you attending, please drop in your questions throughout, which is this R star, this neutral or natural rate of interest. Do you feel we're there, or what's kind of your R star take?
The tricky thing with R star, of course, is that it's not perfectly observable, right? Until you look back and you say, oh yeah, we were pretty much there. So I tend to agree with that the capital intensivity of the period that we're living in, the just size and scale of programs that we've seen, not just pandemic oriented, but perhaps especially since then, and then the global trends that we're seeing around electrification, digitization, which we'll get to in terms of AI, supply chain sort of re-globalization. These are all activity generating if the capital intensivity phase of that transition continues, which we believe it will. So that generates activity. It generates probably a little more inflation net. And so from my perspective, that does push R star higher. And it pushes, the capacity of the economy to generate growth without, running away from an inflation perspective higher too. And so I agree with Ed that trends suggest that you mentioned tea leaves earlier, to the extent that any of us have a crystal ball or can read the tea leaves, I think I agree that we're quite close.
So
Lauren, I have a crystal ball right there. So
I love it. You also have a very cute dog. Next time I'll make sure to bring mine.
Yeah, well, you might have seen I had to turn the video off a couple of times because the dog was starting to whine. So I had to.
We want to hear what he or she has to say next time.
Don't worry about that at all.
I got 4 of them, and they're great.
So let's spend a few minutes on AI, and 2 questions, probably more, but the 2 I can think of right now are one its impact, which both of you kind of addressed, but its impact on productivity and just across the industries and the economy. And then more tactically, it's investability, and is it the Mag 7? Is there more breadth than that? So Lauren, perhaps first on the first question, just its impact on, is the hype is there overhype or underhype or what as it relates to its impact on industries and the economy at large?
I think the hype's appropriate, and there's a way we try to think incredibly in a structured way around AI because there's been money and enthusiasm thrown into and revolving around AI so far doesn't necessarily mean it continues, right? And so we want to be precise around why it would continue. And from our perspective, there's a couple of reasons. We looked at to answer this question, all different types of innovations and improvements in productivity and what made them happen. And a lot of it has to do with the sustained capital intensivity and investment to that trend. And there are a couple of things that drive it. The first is government interest. And because of the increasing attention really from a national security and national wellness perspective from, for example, the Chinese and United States governments, but also Europe and elsewhere, we think that this trend continues to get exceptional attention. We've seen, in the US, we're of course very familiar with the CHIPS Act, but we've seen similar types of investment from Europe, from China, even recently in the news this week from Korea to diversify the global semiconductor supply chain. So we'll talk about investability later, but there's, from my perspective, some real government durability of government support there. There's also likely to be durability of corporate support, which is important because when you think about, I don't know, I hope that you all live and work in perfect tech stacks. But if you think about rolling out like an update to Microsoft Office or something, it's so painful in most organizations, right? And so you really need corporate attention and belief that the productivity improvements or even just the competitive necessity to use these tools will be there. And we do see that. And then the potential for, consumers, sort of the holistic uptake of such a tool would have to be there as well. And as of course in the sort of Apple release week, it seems clear that the consumer interest in these tools is very much there as well. And so it's really that perfect storm that creates a reinforcing capital cycle from our perspective. And as compared to innovations that many of us believe in, like electric vehicles, for example, that requires a lot of infrastructure investment. And the enthusiasm around that infrastructure investment has proven to be a bit, potentially more political, a little more ebb and flow to that investment, whereas AI we consider to be very durable from that perspective. So I anticipate that we'll continue to see capital investment in this space. And again, it's not just because it's exciting and because it's driving the S&P 500, but because that real belief from each of these different sources of capital intensivity is there.
Ed, on investability and the Magnificent Seven versus the suppliers or the more mid-cap players in AI or even small cap players, like what is your take on where the wins will accrue?
Well, over the past couple of years, again since November 30th, 2022, when OpenAI introduced ChatGPT, there's been a tremendous amount of excitement about artificial intelligence, and we've seen a lot of the big technology companies that are cash rich and aren't very sensitive to interest rates put in their orders for NVIDIA's GPU chips. And even Elon Musk has weighed in and sounds like he's going to start another company to basically glue together a bunch of GPU chips to make a supercomputer. So a tremendous amount of money is being thrown in this area. And I'm sort of mixed emotions about AI. So far, my conclusion is that it's definitely artificial and it's not intelligent. And what I mean by that is that the ChatGPT version of AI is kind of like autofill. It's autofill on speed and steroids. It's really, really fast at just giving you something that sounds pretty plausible. But then when you start to read it and look it over and fact check it, you find out that it makes a lot of mistakes. I think open AI, where it's open to the internet and just sucks in all the information on the planet Earth, is not going to be very effective. I think it's going to be polluted with a lot of disinformation, misinformation, and I think it's going to create its own pollution into the internet by creating a lot of information that just is wrong. Might even start. I've seen it even start to create sources just so it verifies its legitimacy. And when you go to the source, it doesn't exist. I think AI, if it's limited to the corporate data and there's a big motor around it and it doesn't get polluted in that way, I think could be very powerful. I view AI as kind of like quantum computing. Quantum computing is all very exciting, but it's not very practical so far. I think it requires super cold temperatures. But I think Elon Musk might be onto something. These GPU chips are fast. That's what they were designed to for video games. And if you put a lot of them together, you might get a supercomputer that's maybe isn't as fast as a quantum computer, but it's fast enough. Certainly much faster than what we have now, and that could be a tremendous boost to productivity. But I've been talking about the roaring 2020 since the beginning of the decade, and I said, artificial intelligence could be one of the technologies. There was no reason to expect that it was imminent, but I think automation and robotics. There's lots of other technologies out there that lend themselves. Look, the cloud, I think, has made a huge difference in productivity. You don't really need like hundreds of people in an IT department anymore. You can have one person and they can do most of what you need. If you need updates with the cloud, things get updated automatically.
Yeah, absolutely. So staying on markets for one or two more questions before we shift to geopolitics and some other topics. Let's just talk about like relative value, Lauren. I think you and your team have said recently, but I'd love to get your view now or today that you can trim some of people can consider trimming some of their gains in equities and looking to high quality fixed income. Or I'd love to ask both of you also about, we've been talking about the US primarily, but equities out ex-US and what the relative value you see there is. So like on a more tactical front, Lauren, what kind of suggestion or advice have you been offering on the gains in US equities?
Yeah, sure. Well, first and foremost, valuation and even relative valuation is a horrible market timing tool. And so just because, for example, someone may say equity valuations have moved higher and they are high relative to historical experience, doesn't mean they can't just keep on grinding. And so with that as sort of pretense, we have to look at really, where we see the economic tides moving. And because we have not seen those market triggers that I identified, we remain relatively constructive on equity market performance, US equity market performance moving ahead. But we are seeing investors increasingly concerned about those levels of valuations. And so as we think about relative approaches, what I'm not saying is go sell all your large cap growth equity. But what I am saying is if you had a 60-40 portfolio even 6 months ago and haven't rebalanced it, you don't have a 60-40 portfolio anymore. And so a couple of the trends that we see potentially developing over the next, say, 6-12 months could work in favor of, if you're worried about US equity valuations, you can take equity-like risk, and we're quite constructive on the credit cycle this time around in fixed income, especially in high yield bonds, where you get a very attractive income ratio right now because of where interest rates are. And look, your price risk is very similar to equity. If the US moved into recession and both Ed and I proved to be wrong on a short-term basis, then you're going to see both equity and high yield have price hits. But you get income in high yield in a different way. So we see that as kind of an out of consensus, but interesting way to take risk. But to your point, a couple of other things, you wouldn't believe it, but if I show you a chart of US and other major developed country indices, US had the Magnificent Seven, but those other countries like Japan, like the Euro area, have performed just as well. And we see the profit cycle in Europe and some of the structural changes in Japan as looking very attractive. And so we've been rebalancing a bit towards international equity as well. And then a final one, which I think is a little early, but if you do expect that the Fed is going to cut interest rates this year even once, then it's a really interesting time. It creates sort of an interesting market timing or bottoming opportunity, especially for investors that maybe have a large cash allocation and are looking to move that into the market. And so for anyone who is in that circumstance, we're seeing some early signs of market bottoming in mostly ex-US real estate, like in Europe, but we think that bottom might be coming in the next 6 months in Europe as well. But also even just into short duration fixed income, like municipal bonds or short duration, investment grade bonds as a way, again, to lock in higher rates if you do expect that rate cycle to shift in the near term.
Mm-hmm. Yeah, Ed, same question to you. Applying the Yardeni model, is there relative value to be had in fixed income or elsewhere? And also your take on international equities.
Well, we concluded that we were in a bull market back in November of 2022. So we got pretty close to the bottom there. And since then, we've been recommending overweighting technology, industrials, financials, and energy. And 3 out of 4 ain't bad. Energy has been sort of a clunker, but kind of view energy as a shock absorber in the event that all these geopolitical tensions of wars that are occurring right now do, in fact, at some point have an impact on the price of oil. That has not been the case, which I think reflects the fact that the global economy is muddling along. It's not booming. It's not in a bust. The U.S. is doing very well on a relative basis. But we would continue to overweight the U.S. and kind of combining this question of yours with the previous one about AI and how you invest in it. I guess my view is a fairly simplistic view, and that is all companies are now technology companies. They either make it or use it. Back in the 1990s, the technologies that were available had very limited use. Word could replace electric typewriters, secretaries on electric typewriters, and Excel could help you out with maybe reducing the headcount on bookkeepers. But other than that, it really didn't lend itself to across the board productivity gains. I think that's what's different this time around is the technology revolution has evolved to the point where a lot of these technologies are very powerful, relatively inexpensive, very user friendly, easy to install, easy to update. And so I think while the focus right now has been on the Magnificent Seven, I think the 493, the S&P 493 has plenty of value. That area has a multiple of 18 forward, whereas the S&P 500 is at 21 because the Magnificent Seven are at 30 on a forward earnings basis. But I think Lauren's right. I mean, there's certainly some great companies overseas that are doing quite well. But we would overweight the U.S. It's a little late to be jumping on board the India train, but that's there's a tremendous amount of potential there. I would not invest in China. I think China's clearly looks cheap, but I think the government's demonstrated that it's too meddlesome and changes the rules too often, in my opinion. I think commodity prices are generally going to stay relatively subdued, so that argues against investing or overweighting countries like Brazil, which is very commodity intensive, even Canada and Australia. Their profit margins tend to be very highly correlated with commodity prices. So I don't see that there's much going there. And I'm impressed by the fact that the price of oil has stayed so subdued, given the geopolitical concerns that we all have. But that it is what it is. And I think it all suggests that commodities are not going to be an asset class that's going to be a big winner here.
I just want to remind our attendees we have about 10 minutes remaining, so please add any final questions and I'll get to those in about 6 or 7 minutes. Lauren, to you on geopolitics, I have 2 questions for you. The first is just as a factor in investment decision making and economic outlooks. It seems as if in the past I don't know, maybe decade or so, it's kind of come to the fore, and you were asked to author the chapter in the CFA Level 1 curriculum. Like, why now, or why has it become kind of formalized as a factor in investment decision making?
Well, I think geopolitical risk is always present. And actually, if you had asked me 5 years ago, well, they did ask me 5 years ago when I was writing the chapter. It's like, look, this geopolitical risk can obviously have a meaningful impact on investors, but incidence of geopolitical risk was actually down in the 2010s, lower than most decades previous in terms not only of the incidence but also impact. That's turned around a bit in the 2020s, but we're not necessarily just talking about big events like wars that get a lot of attention. And frankly, when speaking with investors and in participating in investment committees and investment teams, a lot of times we waste a lot of time on geopolitical risk because it's really interesting. And thinking about what could happen and what it would mean and is this happening can, again, it's not to say that it's a bad use of time, but it can be unstructured and end up diverting investment teams as opposed to being focused on action decision making. And so, as a really simple rule of thumb, of how to focus on action, not distraction. There's two real ways that geopolitical risk makes its way into a portfolio. The first is you have an event risk. That can be something that's unexpected. It can also be something that's expected, like an election. And really what an event risk is a trigger point. Typically an event risk, if you're seeing, again, election, a terrorist attack, even a truly geo event like a flood or a famine, you may see impacts first to currency, to proximate asset classes like the local country's equity and bond market, local countries' interest rates, that type of thing. The second type of geopolitical risk, though, is when you have a paradigm shift. And what I mean by that is there's an initial shock, the event risk itself. And then usually within a couple of weeks, the impact to asset classes starts to look totally different. I actually think the Russia's invasion of Ukraine is a really perfect example of this dynamic, where Russia invades Ukraine, and for a week, really 2 weeks, you have impacts to oil, natural gas, corn and wheat, the Russian ruble, Russian equity, all these asset classes that were proximate to Russia and Ukraine. After 2 weeks, the most impacted asset class of that conflict was the German Bund, up 200%. So what is that about? That's about we'd just been on the other side of the pandemic shock. Everyone was kind of paying attention to this supply chain re-globalization dynamic. And then you have a shock like this where you're worried about flow of energy, and inflation became the global narrative, right? That's when you started to see markets really react to the idea that, for a couple of months, we've been talking about, will inflation be a problem? Is it really going to be transitory? And that was your signal that maybe not. And so as we consider geopolitical risk and whether it's worth paying attention to, I think that those are your real questions. Like, is this an event risk or a paradigm shift? And there are investors for whom event risk is really important. And then there are investors for whom it's not. One of the things that we found, and I'll end here. One of the things that we found is that a macro volatility little satellite in a portfolio, think oil, gold, digital currency. It's so far, if you'd put it on January 1, 2020, it's the trade of the decade. And so as we think about even more structural trends like investment in AI, there's not enough raw materials on Earth to power AI in the next couple of years. There's a lot of infrastructure and transition in real assets and electrification that are going to have to happen.
Yeah.
You add this geopolitical risk modest uptick onto it, and we do believe that on a structural basis, some of this macro volatility or even infrastructure real asset section of a portfolio where we're seeing investors have more attention makes a lot of sense.
Ed, so one more question to you, and then we'll go to our audience
Sure.
questions before we run out of time. We've heard from our society members over the past, honestly, 9 to 12 months that this upcoming US election is a bit confounding in its investability or what to be looking for exactly. And it's, you know, it's June 13th. It's kind of been pulled forward. The first debate, I think, is 2 weeks from perhaps today. What are you watching most closely? Like, what do the nominees agree and disagree on that is top of mind for you?
I think the situation is pretty fluid. I mean, it looks as though it's going to be a very, very close race. If it's too close, that may have some detrimental impacts on sentiment and could unnerve the stock market until things are settled and until we know who the president is. So there are certainly some issues that are coming up. Well, we all know that every time an election comes up, it's described as the most consequential election of all times. But to Lauren's point, I think domestic politics and geopolitics kind of have the same impact on the stock market. The stock market's proven to be remarkably resilient to domestic political crises or uncertainties and to geopolitical crises. And more often than not, the stock market has turned out to, it's been a buying opportunity when a geopolitical crisis hits. We saw that within a few weeks of the Cuban Missile Crisis. I mean, the stock market bottomed when the U.S. attacked the Japanese Navy in Midway. That was just a few months after Pearl Harbor, and the market already kind of figured out that, you know, we're probably actually going to win the war, and that was one heck of a call at that point. So I think we focus too much on the macro and economy and the macro politics, and not appreciate the extent to which all of us working stiffs go into the office every day or to the factory, wherever we work, and we try to put in a good day's work to increase our standard of living, our families, our community, our countries, and we're succeeding, notwithstanding or despite the meddling and the muddling going on in both domestic and geopolitical realms. So I can't say that there's. I'm spending a lot of time listening to every thing that coming out of the Biden camp or the Trump camp. I think there is a significant risk to the roaring 2020 scenario that I've been laying out in trade protectionism. When people, when I've talked to people about the roaring 2020s, there seems to be a sort of a pessimistic bias to always find what could go wrong, and everybody tells me, well, yeah, but it didn't end well, which is true. We had the great crash, and that started in 29, and then 1930 in the first half, the market regained half of what it lost. So it wasn't really a big deal until the Smoot-Hawley tariff was passed in June of 1930, and that basically shut off world trade, and that's what really caused the great crash and the depression. So I would say that the big risk to my happy roaring 2020 scenario would be trade protectionism. And as I said, both the Biden and the administration and the potential Trump administration seem to agree that China has been cheating in terms of the rules of the World Trade Organization, and they need to be stopped. And maybe the only way to stop them was significant tariffs. So I think if we had something like that, that could be very disruptive to globalization and to the stock market.
Yeah. We have just a few minutes left. So I'm going to serve up 2 questions from the audience, kind of rapid fire. The first, great question from Don, which is the Fed or should the Fed be balancing the risks of higher for longer with the cost to service US debt? Is that something the Fed is paying attention to and or should be paying attention to, Lauren?
Probably not. You know, they care about prices in the labor market. They're inherently cyclical factors, and of course, that impacts the cost of debt for the government. But they can't control fiscal policy, and you know, nor do they think they should. And so it's a bit of a dangerous consideration, to be honest. We have a question too about, you know, how worried are we about debt service? And so I'll answer that very briefly, which is that, look, as long as we issue debt in the world's reserve currency, it really gives us quite a long leash. What would make the US dollar not the world's reserve currency. It's typically not geopolitical, actually. It tends to be innovation, a more efficient system. Moving from the pound sterling to the dollar was a little bit about the world wars, but we also in that same time period invented the Federal Reserve System and the telegraph and commercial aviation, and essentially stopped shipping literal silver and gold around the world and started using fiat currency. So I think where this combination of innovation, rising debt and deficit in the US come to a head are probably in a digital currency. Some more efficient currency system, that's my best guess of what it might look like, that then makes the trend, not just the level, but the trend of US debt service more challenging. So if the Fed were worried, they should probably spend more time looking into that. Central bank digital currency. We're a little slow on it in the US.
Yeah, that's true. Ed, last one to you, and you can grab the crystal ball over your shoulder. But a recession in the U.S., would that be a function of the economic cycle? I think we know your answer to this, by the way. But would that be a function of the economic cycle ending, or some sort of external exogenous shock?
Yeah, look, the history of recessions is that in the past they've typically been occurred as a result of credit crunches. So the Fed would raise interest rates, and at some point the yield curve would invert because bond investors basically were signaling that if the Fed continues to raise interest rates or doesn't lower interest rates soon, something will break in the financial system. And it's been uncanny how accurate the inverted yield curve has been in terms of, sure enough, a financial crisis occurred, and that financial crisis then morphed into an economy-wide credit crunch, or even good credits, good borrowers were finding it hard to borrow. And it's the credit crunches that cause recession. It's not inverted yield curves. And the inverted yield curve this time around got it right again. We had a financial crisis last year, the banking crisis. It was on March 10th. It was a Friday. On March 12th, the Fed came in and introduced some liquidity facilities, one liquidity facility, and it worked like a charm and averted any sort of bank run. And so we didn't have a credit crunch, and therefore we didn't have a recession. So the yield curve got the financial crisis right, but the Fed kept that from turning into a recession. Another way we get recessions is with massive spikes in oil prices. We saw that in the 70s, even in the great financial crisis. People forget, but there was a very significant increase in the price of oil to a record high. I think got to $150 a barrel. So that contributed to the problems back then. So I think those are the two events that lead to recessions. And as I said, I think inflation is going to stay moderate because I think productivity is making a comeback. I think globalization isn't completely dead. I think the Chinese are going to continue to export deflation to the rest of the world in goods market. And if that's the case, there's no reason why the Fed would have to raise interest rates to the point of causing a recession in order to bring inflation down. And meanwhile, the United States has become the world's largest producer of energy products, both oil and gas. We're now starting to export a lot of liquid natural gas. We're producing 13 million barrels per day in the oil fields, and that's helping to avert an oil spike, even with these geopolitical risks.
Yeah. Well, before we let our speakers go, I just want to note that both of these panelists are utterly prolific. No one knows how you do your jobs, your day jobs so well, and produce so much insights and research and content online. You should follow both of them on LinkedIn. They're very active on LinkedIn. You can also trial the Yardeni Research's research at yardeni.com.
It'll be Yardeni.com.
Yardeni.com.
That's it.
But yeah, please follow both of them on LinkedIn and online. And I want to thank the two of you for spending so much of your day with us, for sharing your insights. Thank you to those of you who joined live, and to the many of you watching this right now as a replay. Thank you to the CFA Society of San Francisco for hosting us, and we hope it was valuable. Have a great rest of your day.
Thank you, everybody.
Thank you all.
Thank you.